Alright, we back once again with another video. This video, I think a lot of people have been wanting to see this kind of thing, but how to read options premiums part 1. Okay, maybe I'll do like a series here of just the stuff I know about it. There's probably a lot more advanced tactics and techniques, but this is just what I've picked up over the years, and just a quick intro into sort of the basics of it. Basics of how I do it. Now this, like I said, this is how I do it. I've never really seen any textbook ways of doing this. This is just what I've picked up. So without further ado, let's look at, this is the options chain for SPY in Tastyworks. And the reason I like Tastyworks, there might be other platforms that do this, but the reason I like Tastyworks is because it's going to give you the distribution based on volume with these lines here. So this is the standard deviations, 1 and 2, 1 and 2. So these are the calls, these are the puts. You know, you got your bid and your ask, your open interest, and volume. These are the most important things to look at, in my opinion. A lot of people like to look at the Greeks, you know, but and the Greeks are important. Like if you're the type of trader who trades off the deltas and stuff like that, that's going to be you know, more, you know, your thing. But what I'm going to show you is a way to kind of tell where a stock is, how it's kind of balanced out, and I have a couple of good examples that I was going over with my buddy earlier, so I thought maybe this would be decent content for people to see. But so, you know, here's SPY. All right, here's how it closed on Friday. And okay, that was essentially Black Friday. Actually, a flash crash on Black Friday. It's just so ironic that it came true. And so, but what we see is we're looking at the first standard deviation. So here's SPY where it closed. We're looking at the first standard deviation here. And then this brown bar here is going to be your expected range. And that's just going to be sort of based on, you know, what's going on in the options chain. So that's why I like Tastyworks. It's going to give you this layout here. But what you can see is if you go to the first standard deviation strike, so here's the 453 puts. You got a 140.268. Now this doesn't matter that the spread it's closed. So the spread doesn't really matter here. But the overall premium amount, you're looking at about 268 here on the ask. Look at the ask here at the first standard deviation higher. All right, so it's 65 bucks up and 268 down. So what does this picture tell you essentially? Well, essentially it tells you that that participants in the market are positioned to the downside, right? They're adding premium to the puts at such a staggering rate. There's so much volume and so much premium there that it's actually got the price of the puts almost 3x, pretty much 4x its counterpart, essentially 1 standard deviation up. So this is how you would find, essentially, if you were expecting a reversal or if you're looking for a reversal, this is what I would be watching, this little area here, to see if those premiums start to come balancing out again. All right, so let's go look at Facebook real quick, because Facebook had some unusual whale alerts, so some unusual options activity to the upside as its most recent alert activity. And so I was looking at actually no, I'm sorry, it was to the downside. It was 325 puts, someone buying a large amount of these 325 puts for Friday. So I was like, well, is this a good play? But if we're looking at the options chain here, we see the premiums essentially at the first standard deviation and the expected range. They are favoring the put side, but not that much. So you can see the difference here. So the first standard deviation is 2.2, 1.7. See the difference. So if you were bullish or bearish, there's the 2.68 and 6. So 4x the price there. 4x the price there, and you know, basically it's a 1 and a 1.5. You know, the price there. So the premiums aren't that expensive here yet. The premiums on SPY were just ridiculous. Being 4x the price. Every time I see 4x or 6x the price, I'm buying calls here, because, you know, my thinking is if someone's out there looking to buy contracts, either they're buying these contracts because they're super scared of some crash, or they're going to stop buying them because they're just so expensive. And at some point they're going to go, well, look at these calls. They're so cheap. right? I mean, they're within the expected range, and they're so incredibly cheap versus these calls. Eventually, all the put buyers sell their puts, unwind the market higher, and they're buying calls because all the money that they made on puts, or if they even made money on puts, because it's really hard to when the put prices are so high. Eventually, that drives all the money into the calls, and that's where you start seeing the appreciation on the call side. So this is my general theory. Okay, this is not like a trade setup. This is just a general way of reading the premiums, learning the balance of prices, and getting an idea of how bullish or bearish a chain is, a certain chain. So here is Facebook again. So someone was buying these 325s at like 340 or something like that. Okay, so I don't know what their goal is. Obviously, it is to make money, but at what point are they taking profits? We don't know that. We just know that in general, the premiums are fairly bearish on Facebook, and it obviously wasn't a huge. It was down $8 for the day, so it makes sense. But they're not that bad, not as bad as SPY. You know, the ratio isn't that bad, but I would still be looking at puts on Facebook because these premiums are slightly elevated. They're not it's not overbalanced in my opinion. And so let's go look at mRNA. We know mRNA up 56. I think it was up 75 at one point. This is a good example of what an options chain looks like into a bullish stock, and why it's kind of hard to get into the play, because look at the premiums here at the 1 standard deviation, 3.8 to 7. Now again, someone with more options experience or understanding can maybe have a better explanation for this, but this is just how I've been looking at it for years, and trying to find overpriced options is, you know, just looking at the difference here. So you got about a 2x difference price on the call side versus the put side. So that just means that the stock is extreme bullish right now, because you know obviously all the action is driving the price higher into these premiums. So this is one way to look at it, and then another way is you can look at, okay, so we've got the $7 premium here. Okay, so that's 40 points up from where it's at. And then our next $7 premium, so this is just another way to look at it, but next $7 premium I see here is the 305, so 25 points down. So as far as the balance of premium goes, you get 25 points down and 40 points higher. And so that gives you an idea that the stock is balanced on the call side heavily. And so when we can go look at SPY and do the same thing. SPY 465s or $65. Our next $65 put strike, you know, somewhere around, you know, 20 points down. 20 points down, they're priced in the same as essentially 6 points up. So that's another way to look at premiums and kind of gauge whether a stock, whether the prices are cheap, they're fair, or whether they're balanced, or whether they're underpriced, blah, 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 so on and so forth. A lot of people are like, well, how does this guy, you know, smarter trader find, he might have a different sort of model. I know it's similar to this though. It might not be exactly this, but I know it's similar to this. And so you can basically gauge where the market is. So on let's just say Wednesday, okay, let's just go look at SPY real quick on Wednesday, just to give you another example here. So we'll just look at ES. All right, so Wednesday, here's Wednesday, okay? Wednesday we open up right here. I'm gonna turn that off for a sec. Wednesday we open up here, we're gonna test these previous lows. And the price on the SPY calls, on the ES calls for the 4700s, were about 1.4. And so that was, you know, that's about 40 points up. Okay, so they're pricing the 4700s as the stock is moving down. They're about 1.2, 1.4. And so, and then you go 40 points down, and the price was about $4, and maybe even $6 at one point. So it was almost a 6x difference. Are you going to be buying puts here at 6x the calls? It makes no sense pushing into support. And this is what I was saying on my stream. It makes no sense pushing into this support zone here, which you basically have this whole area here, at least until it's broken, is support. You're going to pay 6x the price on puts versus, you know, super extreme cheap calls. I think that's why the market ripped, because the prices were just so out of whack. You couldn't buy puts and make money. Even if you bought them and it crashed, you barely make anything. So that's the idea. They had to unwind those puts. And looking back, 2020 obviously is hindsight. There was a reason the puts were priced the way they were. It was just too high. Okay, they knew this crash was coming. They knew the market was super fragile, and puts have been super expensive lately anyways, but it was too expensive. And so they had to unwind those a little bit just to kind of drop the premium and try to balance this market out a little bit. And of course, you know what happens, the market just completely craters. You know, after the puts and the calls have kind of dwindled out as far as the theta kill a little bit, that's when they dropped the market like crazy. And the puts were just extreme priced all day. And so once it got down to about right here, you started seeing the balancing a little bit, and then they crushed it again. And so I'll tell you what I mean is prices were about 4x puts all the way down. Okay, until you got about right here, till they're about 6x again. And I don't know if the 6x thing is, it's just the 6x calls is about what I'm seeing as far as like that's where you're going to start seeing your bottoming, because it just becomes, the risk reward just becomes ridiculous to buy the 6x puts. You want to buy, you know, 3x maybe, because puts are usually expensive anyways versus calls. But anyways, that's where you hit about that 6x price point again. They got it balanced here. So again, watching these premiums all the way up, all I'm doing is watching these SPYs or these ES. Really, I'm watching the ES calls, and I'm looking at the first standard deviation here. If you look at the price now, they're about 3x right now, 4x, 3.5x. But they had them balanced. So they got them to about balance here is really about this level, to be honest with you. I mean, they were about 4 or 5x here. Obviously, the open was a fake out. They got them balanced there, not even quite balanced, but almost to 1-to-1. Cratered it to where they were like 6x again, and then they got them to about 1-to-1 again, and then they cratered them again. So this is a way you can read premiums. Hopefully this helps you a little bit. If you have more questions on this, I will do more videos on this as you know, I get more ideas for content and more ideas of how to read this type of thing. We'll definitely include some of this unusual whales flow in this as well. How I found an Apple play for one, like basically I hit it from about $1 to about 75 bucks. Not 75 total, about 7. It was like 1 cent to 75 cents. But I was using this technique here to do that. This and options flow. So anyways, until next time, if you like this, hit the like, subscribe, and we'll see you in the next video.